Good morning, everyone. Thank you very much for joining us on today's episode of True Potential's Morning Markets. In today's video, we would like to look over the latest US inflation data that was posted yesterday afternoon. Yesterday we saw the latest release of US inflation, and as always in these videos we like to focus on the two measures that get released. That's headline inflation and core inflation. So as a quick reminder, headline inflation includes all the items in the basket, whereas core inflation, we strip certain items out which are more volatile, and that includes things like energy prices and food to get a more narrow range or measure of inflation. Now, what we're seeing within the US is that theme of disinflation continue, where we see the rate of inflation fall, and that is applied to core inflation, which has fallen down to 4.1%. However, we have mentioned in previous videos that the expectation is that inflation may reach a level where it starts to become sticky, and those falls in inflation start to become harder to occur. And that's what we're starting to see with headline inflation, which remained at the previous month's rate of 3.7%. Now, the reasons that headline inflation has remained stickier is due to partly some of those more volatile elements that we'd spoken about, such as energy, but it's also coming through from higher shelter prices. Now, how have markets reacted to that? Well, we saw in the US that assets reacted negatively. So we had bond markets where yields rose by approximately 14 basis points on the day, and the S&P 500, so the US large cap equity market, that fell by roughly about 60 basis points during the day. However, what we can tell from looking at market pricing of certain instruments is that market participants aren't actually expecting any change in interest rate policy from the Federal Reserve as a result of that inflation print. So thank you for watching today's video, and we'll catch you on Monday for next week's video.